While credit cards offer a multitude of benefits, including free travel, rewards, perks, and building credit, it's important to be aware of their potential drawbacks as well. Though credit cards can be a valuable asset in managing your finances and reaching your goals, they come with a few disadvantages that can affect anyone regardless of their credit history or current financial situation. In this video, I will shed light on these often overlooked disadvantages of credit cards and equip you with the knowledge you need to make informed decisions. As credit cards become increasingly accessible and widely accepted, it's not surprising that almost everyone has one, with businesses promoting their use and a growing shift towards a cashless society. It's becoming easier to rely on credit cards for daily transactions. However, this convenience can also lead to temptation and overspending, which can result in financial difficulties. It's common to hear about people who maxed out their credit cards as soon as they received it. The ease of access to credit and the temptation to spend can quickly lead to an overwhelming amount of debt. This is a situation that many of us have likely experienced at some point in our lives. Having a credit card available can feel like a large sum of money at your fingertips, which can be tempting to use. The psychology of overspending on credit cards is very complex, and various factors may encourage people to overspend. For example, we live in a society where we want instant gratification. It's a mindset where there is prioritization of instant pleasure or fulfillment right now without waiting. But in the long run, this can lead to excessive debt and a lack of financial stability. Additionally, credit cards create a false sense of wealth due to their high credit limits, making it more tempting to overspend. However, this perception of having more money can rapidly fade if there's not enough actual money to cover the costs, resulting in financial difficulties. Suppose you're struggling with the temptation to overspend. In that case, it's crucial to have a realistic understanding of your finances, and this can be accomplished by creating a budget, setting spending limits, and avoiding impulse purchases. Alright, so this may seem kind of old school, but I have a budget notebook. Every month, I like to take out my trusty notebook and put it to good use. It may look like an ordinary notebook, but what's inside of it holds great value. Creating a budget each month lays the foundation for financial success and curbs overspending. I like to include my monthly income and fixed expenses, such as credit card and car payments, and record all expenses made during the week. Then, I make weekly necessary adjustments to my weekly spending based on my budget. It's crucial to have a financial plan, and this simple notebook has made all the difference in my life. I've overcome the struggles of overspending, and this has brought a peace of mind. And I say this all the time, just like a cluttered room is a cluttered mind, disorganized finances can cause the same thing: anxiety, stress. Having a budget notebook can help alleviate stress and overcome financial difficulties. One significant disadvantage of owning a credit card is the presence of high interest rates. Credit card interest rates are higher than other forms of credit, such as loans, because credit cards are classified as unsecured debt. This means that there is no collateral available for the lender to hold on to in the event you don't pay them back. This higher interest rate compensates for the increased risk by the lender. They are lending money out without the security of collateral. According to CNBC, the average credit card interest rate is projected to reach 20%, with many individuals having interest rates that exceed this average, ranging from 14 to 29%. Carrying a balance from month to month can result in paying high interest, creating a cycle of debt that can be difficult to escape. For example, if an individual has $5,000 in credit card debt with an interest rate of 29%, they will have to pay $120 in interest charges alone each month, making it challenging to pay off their debt. This situation can become very overwhelming. To avoid the burden of high interest rate debt, it's best to make a habit to pay off your credit card balance in full each month. This can be achieved by setting up auto payments, which will automatically make the payment by the due date. Also, being mindful of your spending and sticking to a budget will help you stay within your means, preventing any interest charges from accumulating. Fees. Fees associated with credit cards can be a major drawback. There are various fees that come with credit cards, such as annual fees, late fees, cash advance fees, and more. These fees can quickly accumulate, reducing the benefits and rewards you receive from using your credit cards. For example, it's important to consider if the benefits of a credit card with an annual fee are worth the cost. So if you rarely travel, paying a high annual fee on a credit card may not make sense. Late fees are also a significant issue as they are charged when you fail to make the minimum payment on your credit card by the due date. Late fees typically range from $25 to $40 by most banks and credit unions. Cash advance fees can also be a concern. While taking out cash with a credit card may be necessary for certain financial situations, doing so will result in an increase in your credit rate. So for example, if you have an interest rate of 27% and take out a cash advance, the interest rate on the amount you took out can increase your interest rate by at least 2%, resulting in an interest rate of 29% on the amount you took out. This can have a negative impact on your financial health. To minimize or avoid credit card fees, it's important to choose a card that fits your needs and provides enough value to justify any annual fees. You should compare different credit cards and their benefits to determine which one is right for you. To avoid late fees, you want to make sure you know your payment due date, set reminders, and consider setting up automatic payments. To avoid cash advance fees, consider using a debit card to withdraw cash. However, it's best to avoid cash advances altogether whenever possible. One of the drawbacks of using credit cards is the potential impact on your credit score. Your credit card payment history and utilization play a significant role in determining your credit score. Late payments or exceeding your credit card limit can decrease your score and make it more challenging to access credit in the future. If you miss a payment on your credit card, it can result in a 150-point drop to your credit score because your credit score is 35% payment history, which can stay on your credit report for 7 years and affect your chances of getting a credit card or loan in the future. Banks, credit unions, and credit card issuers, and even employers view missed payments as a sign of unreliability and a lack of responsibility. A history of missed credit card payments can also suggest financial instability or excessive spending. This is why missed payments can have a detrimental impact on your credit score and remain on your credit report for an extended period. If your payment is less than 30 days late, it won't negatively impact your credit, but you may incur a late fee. However, if the payment is overdue for more than 30 days, the credit card issuer may report the late payment to the credit bureaus, which can result in a decrease in your credit score. If the payment is overdue for over 60 days, the lender may consider the debt uncollectible and send it to a collection agency. Missing a credit card payment can have serious consequences for your credit. Not only will the late payment show up on your credit report, but it could possibly be a delinquency as well. This can be challenging to obtain any other forms of credit until the situation is resolved. Credit card utilization is also an important factor in determining your credit score, accounting for 30% of your score. Credit card utilization refers to the amount of credit that the cardholder has used relative to their credit limit. It is calculated as the amount of credit used divided by the credit limit. For example, if a cardholder has a credit limit of $10,000 and has used $3,000 of their credit card, then their utilization would be 30%. High credit card utilization can be a sign of financial strain or excessive debt and can negatively impact a person's credit score. On the other hand, a low card utilization can be a sign of responsibility and can positively impact a person's credit score. Keeping your credit utilization below 30% is generally recommended to keep credit scores healthy. While owning a credit card does come with some drawbacks if not used responsibly, the advantages of credit cards greatly outweigh the disadvantages. This video aimed to shed light on the potential downsides of credit cards with the hope that you will use this information to make informed decisions when it comes to using credit cards. By using your credit cards wisely, monitoring your spending, and making a budget, you will be set up for success in your credit journey. Thank you for watching, and remember to smash that like button, subscribe if you haven't already, and I will catch you guys on the next video. Peace.